Great pleasure to bring on board now Mr. Ashwani Bhatia, Managing Director with State Bank of India. Mr. Bhatia, SBI numbers in last 2 quarters have forced a lot of naysayers who've used words like SBI cannot turn around, SBI is too big, SBI is a PSU company. All the naysayers now are coming out with upgrades and change of opinion on the stock. So fabulous performance, not for the quarter gone by, but for 2 quarters on the trot. But now let's understand the fine print. Now that markets have digested the numbers, there are some not eyebrows, but there are some naysayers who tend to believe that how will SBI achieve a 10% growth, a 10% credit growth when the aggregate credit growth is going to be less than 10%.
So thank you, Nikunj. So just responding to your opening remarks, we are big, we are a PSU, and we have turned around. To your question that, whether we can have a 10% growth, it's quite simple, right? So last year we grew about 16% in retail, about flattish on the corporate side, where we did not grow at all. Obviously, when you talk about the corporate book, it is more a function of how the economy is doing. So assuming that the retail book will remain robust, we are actually already seeing decent amount of inquiries coming in. A lot of investment capital will be generated during the year. And if you look at the overall factors, I mean, today we are in the midst of the second wave. We think that as compared to the first wave, we are much, much better off. And demand is actually coming into the economy. So if you include all our investments in CPs, in bonds, NCDs, so on and so forth, I think that number of 10% growth is possible. So even the number that we've shown this time, if you include the investments in CPs, in bonds, the number is a little higher.
Mr. Bhatia, the shape of the economy is such that big companies are getting bigger and small companies are getting marginalized. Now, the challenge for a bank is, not for SBI, for any bank, is that big companies now have the option to go to the bond market or the debt market and raise capital. And that market is now becoming a very large and a vibrant market. Is that a big challenge for a bank like SBI? Because while you have the availability of capital, willingness to lend, but corporates may not come to a bank.
Well, in a way, I think it should be a welcome development for the economy. The risk is not entirely on the banks. That's the first thing. The bond market and the equity market, the investors are there for better rated customers. So an A, AA, AAA obviously have very easy access to the market. We think that the growth actually, when you talk about manufacturing and all, would be more on the BBB side, on the A-rated companies. That is the part that does not have access to the markets. So we think that segment will grow quite fast this year.
One large contributor to any bank in last 1 year has been the treasury income. Bond yields came down. A bank like SBI was sitting on a large treasury gain and a large treasury portfolio. That may not be a reoccurrence for FY22. How does that change the dynamic for the treasury book?
So that's something that we look at very intensively and very, very actively. Suffice to say that currently our modified duration in the AFS book is around 2. So that if in case the rates move up significantly, there isn't much mark-to-market hit. But let me also tell you that there are plenty of other opportunities that you can exploit with a book as big as ours. So our treasury book alone, it's there in our investor numbers also, is close to 13 lakh crores. So as compared to the smaller banks, obviously we can't be as agile, we can't change the duration overnight and all, but it is something that we keep a very close watch on. So if earlier on we had profits from the sale of investments, if the bond yields actually go up, it will come to us in the form of interest income. So we don't see much risk over there. And finally, look, mark to market is just a number, right? So it does impact the balance sheet overall. But I think we are very well aware and very well cognizant of the fact that that is one area which we need to take very seriously and at the same time carefully also.
In next 12 months, will SBI General Insurance and SBI Mutual Fund, will they both go public or only one will go public?
Possibly only one. You already know the name. We've discussed this a number of times earlier also. Of course, that needs to be taken to the board. And I guess maybe within the next year and a half, you could be having a listing as well.
As we recover from the pandemic crisis, SBI also has turned around. Last 2-3 years, SBI was in a repair mode. You were in the process of writing down the bad NPAs, in the process of consolidating your balance sheet and the loan book. Will you be in a growth mode now for next 12 to 24 months? I mean, will we see the original SBI which led the growth and led the entire, led the entire growth for the country?
Surely. Coming back to your first question, if we are able to do 10%, number one, and number two, if we are able to increase our credit deposit ratio, now that number is we realize is 61% currently. If we are able to move that needle towards 65, 66, and as I said, there is going to be demand in the coming months, especially from the manufacturing side, from the pharma side, we think we should be leading again as far as the funding of the economy is concerned.
Do you see growth coming back both in working capital loans as well as term loans now?
So working capital is always, again, a function of the demand in the economy. The working capital limits have not been fully utilized in the recent past. We think that as we open up again around Diwali time or so, we should be seeing decent amount of growth and utilization of the limits. On the term loans, again, lots of sanctions are in place. Disbursements need to happen, and because there's a lockdown, I would think that once the economy opens up, we should be having traction on that front also. So roads are doing well. I think airports are going to pick up. Solar is another side, where a lot is happening. If you look at the entire picture right now as compared to last year, same time, we think we are in a much better situation.
Okay, fantastic. While you talked about how the outlook is looking positive and, of course, the street has been pleasantly surprised on the asset quality front, if I can get an outlook from you going forward in terms of the NPA trajectory, what you're anticipating now, over the next year or so, if you could just run us through that, that would be wonderful.
So last year also, around the same time when we declared our results, we guided the market that our credit costs would be within 2%. This time we did, and for the year we did 1.2%. I think in these times, we are in the midst of a wave. People are talking of some more stress coming in, from a third wave and so on and so forth. So let's be conservative. I think we'll stick to the 2% credit cost. We'll strive to do much better than that. So if you have that kind of a scenario, we would think that, our ROA, which was 0.48 on a standalone basis, 0.5 on a consolidated basis, should move up. Having said that, our ROA for the fourth quarter was 0.58. So the trajectory is very, very clear. And we do hope that within the next 2 years or so, we hit a ROA of 1% or so. If that happens, the numbers, our profit would be upwards of 45 to 50,000 crores or so.
Okay. Again, while you've sounded positive on outlook and the street has, of course, read into that commentary, loan growth was a tad weak so far. And while you're expecting that to pick up, if I can get a sense of the segments, you did mention a couple where you do see demand picking up. If we can just go into that a little deeper to see where that confidence is coming from and where you really see strength in the recovery.
So we think that the renewable sector will continue to see a lot of traction. We are also seeing that, a lot of the distribution and the transmission is also moving into private hands. It's moving into InvITs. That's another growth area. That will free a lot of capital for state governments, the central government. We are seeing good amount of traction in roads. There's a good amount of action on the construction side. On the city gas, there is also traction a bit. We are seeing now on the pharma side also. The fact that Reserve Bank of India has said that up to 50,000 crores for the banking sector can be part of the priority sector lending and benefits on placements in reverse repo. That would be another area of growth that we are looking at. Overall, right now, to be very frank, and just to repeat, it looks quite okay.
Mr. Bhatia, what are you doing so differently that you're sounding so confident and bullish and your numbers are reflecting? How come 5 years ago we didn't get this kind of an outlook or delivery from SBI? What has changed?
So I guess it would be the repeated focus on our large credit book, our underwriting, the fact that the entire credit process has changed, the fact that we are today more aligned to markets as far as our pricing is concerned. And of course, the fact that we, I think, have become a little more nimble. Digital has helped. On the retail side, the fact that we can sanction loans digitally online is a big plus. The fact that, our housing book is today beyond 5 lakh crores. All of these things do give us a lot of confidence. The fact that the retail book today accounts for a very large chunk of our overall credit is another positive. So the cleanup has happened and it took us 3 years. You can only look forward with confidence.
Okay. Final question, Mr. Bhatia. When we spoke last, it was in April end. And that time your sense was that there is no large retail delinquency. But if I look at the evidence and purely on-ground evidence, COVID this time has struck rural India a lot more. There is definitely a higher mortality rate, and the numbers here have been very large. Are you getting any evidence, any data which indicates that the collections in the month of May and June may be challenging?
So we saw this last year also. There was a spike in the SMA numbers, SMA 1 and SMA 2 numbers also. But as the economy normalized, those SMA numbers also came down. We think the same thing will happen this time also. So the recoveries are around 95, 96% currently. And as the workforce gets back to their work, salaries will once again start coming back. Let me also tell you that most of our retail is salaried class, public sector undertakings, paramilitary forces, the army, central government, and so on and so forth. So we see not much risk coming there. I mean, it won't be wise to say that there is no risk at all. So, and to a customer who has taken a housing loan, he won't like to lose a home, right? He would do anything to avoid becoming a NPA and having a bad CIBIL score. That has been the experience in the past. And I'm sure this will hold this time also.
Thank you so much for taking the time out and in detail speaking with us about what SBI's outlook is going forward. The stock already knocking 410 almost on the share price.